Right, so NVDA today, another all-time high print. Stock is slightly down today, maybe 1%, 0.7, 0.6%, 131. That's where it closed. So here's what I'm looking at this name. So after reporting earnings, actually after paying out this dividend, well, I was in the camp that it could have maybe pulled back, but I'm looking at a few things here. So first of all, option activity. Before we jump into this chart, let's take a look at that one. So which is, well, today 2.7 million calls were traded, 1.6 million puts were traded. Significantly more calls being traded. And look at these calls. I don't know these calls that are almost like very high delta, right? Like almost close to 1 delta, right? You can see 9%, 60 to 80, 11%, basically 80 to 1. So basically in a lot of in the money calls probably being traded, and it could be buys or sells. I didn't look through this, but one thing standing out to me right here, right now, is both with SMCI. Over the weekend, I was looking at SMCI, that market maker is a bit hedged to the upside. For some reason, they think that there is more upside risk. Again, maybe not, but usually in my experience of looking at option chain, anytime you see, let's say stock is sitting at the moment 131, right? So $20 move in a stock to the upside and $20 move to the downside, at the moment priced totally different. Implied volatility for these calls are significantly higher. Okay, let's take a look at 150 strike price, right, which has today 10,000 volume and 43,000 open interest. It's going for $1.90 bid and ask, versus exact same drop, let's say 110, it's going for $1 puts. So put versus calls. So if you're somebody who's trading calls, you need to understand that especially if you're somebody who's trading outside of the money calls, you are overpaying. You're paying more. It is more expensive. That's what's my point with this. And why it's that? Well, I don't know what else is out there coming out anytime soon in terms of catalyst for the name, but it is pretty expensive. And I don't know why market makers are doing that. Maybe, well, we just looked at the volume put to call ratio. Maybe there is still a lot of call demand. So I looked through the top volumes in general for the stock market today, June 17th. Look at this volume Nvidia had versus the second highest volume, which Tesla had 2.4 million total versus Nvidia 4.3 million total. And you can see put to call ratio, 62% calls came in, 37% puts. Puts could be just being sold and calls being bought. There's no other way I can put it together, because despite stock going higher, there's a lot of call demand. Another thing, I was looking at MACD. When stock, we'll take a look at the technicals as well, what I'm going to be looking at. Let me show this one. On a daily, you can see, yes, MACD is making highs. But if you switch to hourly chart, 1 hour chart, and I'm looking at last like 20 trading sessions, there's a divergence, right? MACD going lower while stock is going higher. I know many people could be talking about divergence in overall stock market as well, because there are only like 6-7 large cap stocks pushing the market higher versus like market breadth, all that stuff. And you have to keep in mind that market can be rational longer than you can be solvent. That's what it is. So, but that's another thing standing out for Nvidia. Certainly, in one day, you can wake up and see it flash like 10%. No problem, you can do that. But just keep in mind that this rally is being fueled by very aggressive options buying versus in general, like stock itself. Like these, I mean, if you look at the volume that is being traded every day, there's nothing unusual going on. It's just basically melting up because of algos buying it, right? And nobody's selling it. Okay, there's not much selling pressure. That's what it is actually. But at some point, people will start taking big chunks of profit. That's when you might see the overall pullback. But this week is very large option expiration in terms of OPEX monthly option expiration. So there's a lot volume about to expire. So, but when stock runs away like this, what do I look at it is basically standard deviation moves. So this is a 2 standard deviation chart that I have for NVDA. So if this stock somehow, again, I know it's going to be a pretty big move, moves 2 standard deviation in a very short period of time, let's say pushes towards 145, that's when I would like to trade this name to the downside, flushy move to the downside. Last time we saw this happen was somewhere around here when I was watching in the beginning of March, and it pulled back like 7-8% or so. But right here, right now on a daily, you can see, yes, it is way outside if you take a look at that way. But if we bring up the moving averages, stock is above its 5-day moving average, 20-day, 50-day, 200-day. Of course, it's very far away from its 50-day. And that was the instance back here as well. It was running away pretty far from its 50-day moving average. And then it just pulled back, consolidated, tested that level, coiled up, and then moved again. So it can happen at some point. But I'm not somebody who shorts when stock is above its 5-day moving average and when overall market has very low volume. I mean, of course, intraday you can trade it, but SPY, I mean, one of the lowest volume tradings in general, like from the end of the April, I don't remember seeing like SPY trade like this, but that's what it is. That's the market we have right now. S&P 500 all-time highs, and where it can pull back. Well, I would be watching this breakout area of 115, but can it push a little bit more towards 140, 145? Absolutely. But I am on the sidelines, not trading this name at all, as stock has been pushing higher with declining volume as well. So very low volume and mainly contributed by option activity. So that's the, I guess, video for NVIDIA. Hope you like it. See you in the next one.